So we'll go through fiscal policy, built-in stabilizers, cyclically adjusted budgets, what governments face when they have fiscal policy, and the Canadian public debt. So expansionary fiscal policy is when an aggregate demand shifts to the right. So this is when government spending increases and taxes decrease, leading to higher prices and higher real GDP. So then contractionary fiscal policy is used to reduce inflation. So they can decrease government spending and increase taxes to reduce inflation. Because so right now, inflation in Canada is near 10%. So Canadian inflation is about like roughly 10%. I think they're downplaying it for sure, but in order to reduce inflation, they can reduce government spending, they can increase taxes, like that's fiscal. So they can do that through fiscal policy. Yeah. So then if they do that, aggregate demand will shift left. So this causes a shift left in aggregate demand. And price decrease, real GDP decrease. So yeah, like governments, when there's a recession, they increase government spending. So recessions, government increases gov spending and reduces taxes to grow the economy. And then expansion, government reduces gov spending, increases taxes to stop inflation. So we're kind of right now in Canada, we're about here. So they're kind of doing that. They're doing some of those policies to reduce inflation because the COVID-19 relief spending has led to a surge in inflation. So the government has to reduce inflation because prices are increasing too much. Yeah. So taxes rise when GDP rises and vice versa. So what happens is, like, let's say 1950 Canadian GDP was, let's say, $100 billion. Probably wasn't, it was probably something different, but then let's say 2020 Canadian GDP is 2 trillion, let's say, right? Let's say the average tax rate is 30%, right? In both scenarios. So let's say it's 30% in both scenarios, just for example, like it might not be that. So then 100 billion times 30% equals 30 billion. So is the tax revenue in 1950. And then you do 2 trillion times 30%. That'd be 600 billion. Tax revenue in 2020. So the tax revenue went up by 630 billion over that time period. Yeah. So Stabilizers are used to like save the economy if there is like a recession, basically. So they so stabilizers can so they mostly keep inflation in check. So they can reduce inflation when inflation is high, and take the economy out of recession. So they can do that. So this comes into play. So like how it reduces inflation through higher taxes and reduced government spending, and then grows the economy through lower taxes and increased government spending. So yeah, those are some of the tools that they use for that. So yeah, they want to reduce spending because too high of inflation is not good for economy. So you see with gas prices, like gas prices are like $1.70. So the government reduces spending to bring down gas prices. And then the increase in spending are desirable when the economy is slumping. So when COVID-19 started, they increased spending a lot to like offset what was happening with COVID-19. So this is surplus. So surplus is when tax revenue is greater than government spending. Yeah. And then deficit is when government spending is greater than tax revenue. So surpluses are good because they're saving money. Deficits are not good because they're like, they're going into debt because they don't have the money for spending. So, but however, deficits can be good in some cases because you can they're good for like infrastructure spending. So like it's kind of like buying a house. Like taking on debt is good for buying a house, right? It's not good for buying, Xboxes or PlayStations or TVs. Like it's good for infrastructure. Like if you're borrowing for infrastructure spending, that's good debt. But bad debt is when you spend it on like disposable products. So the government, like I agree with the government doing deficits for infrastructure spending, but if they buy, let's say, if they're buying like consumer products like electronics with their deficit money, that's not a good idea. Or like yachts or cars. Like if they're building infrastructure with it, that's fine. Yeah. So then, so progressive taxes are when the tax rate goes up for higher levels of income. So like 30% for 50,000 or under, and let's say 40% for 50,000 and over, let's say. So like that's what they call progressive. Like the percentage of tax goes up with higher levels of spending. Yeah. And then proportional is when the tax rate is the same for all levels of income. So like that would be proportional. And then regressive is when the tax rate goes down for richer people. So let's say when the tax rate goes down for people with higher incomes. So for example, then and then like so it'd be like that. The more progressive the tax system, the greater the economy's built in stability. So you want a progressive tax system. That's ideal because it's more equal. Like it's better the rich pay more than taxes. Like a higher percentage of their income in taxes because the poor can barely pay taxes. The rich can pay taxes. Yeah. So the cyclically adjusted budget shows what the budget balance would be if the economy was operating at full employment. So if the economy was operating at the peak of the business cycle, so the cyclical unemployment is 0 in this situation. There are only frictional and structural unemployment. Yeah. And this is when the peak of the business cycle is met here. So Canadian fiscal policy was neutral to mildly expansionary in the early 1990s, contractionary in late 1990s, and then 2009 expansionary fiscal policy. So so this is a chart of how how many years had surplus and deficit. So these years had surplus. So like tax revenue was greater than government spending. And in these years, government spending was greater than tax revenue. So this is a graph showing so in 2016, Japan, Canada, Spain, United Kingdom, United States all had budget deficits, while Luxembourg, Switzerland, and Netherlands had surpluses. So if there's expansionary fiscal policy, so like if government spending is greater than tax revenue, there could be higher inflation than wanted. Therefore, interest rates will have to increase in order to bring inflation down. So the aggregate demand curve will shift right if there's higher government spending and lower taxes. So this is what happens. And then they'll have to raise interest rates. So in this case, 80 goes up. So gov spending goes up, taxes go down, interest rates will have to rise. So whatever happens in, like, let's say the US with the housing crisis in 2008, so 2008 housing crisis, where the housing market crashed, the US this affected Canada. Canada went into a recession too. So like if US goes into recession, Canada goes into recession because Canada's largest trading partner is the US. So this is a good chart on this. So if there's a recession, slow growth, they'll have to do expansionary fiscal policy where government spending increases and taxes decrease, and this will lead to a higher domestic interest rate. And then a higher domestic interest rate will increase foreign demand for dollars. So the dollar will go up in value because a higher interest rate will increase the value of the dollar. And net exports decline because imports will increase. So like imports increase when currency appreciates. So contractionary fiscal policy, problem inflation, so if there is inflation, you gotta increase taxes and reduce government spending to reduce inflation. And then this will lead to a lower domestic interest rate through this. So this will lead to decreased foreign demand for dollars because lower domestic interest rate, so lower domestic interest rates, lower value of the dollar. So then dollar depreciates, net exports increase because net exports increase when currency depreciates. It's cheaper to sell your goods to other countries. So budget surplus is annual amount by which government revenues exceed government expenditures. Budget deficit is annual amount by which government expenditures exceed taxes. Public debt is accumulation of all past deficits and surpluses. So debt and GDP, relative size of the debt fell in the last decade, but rose after the 2009 Great Recession again. International comparisons, our debt is among the lowest as a percentage of GDP among the world's industrialized nations. Interest charges, the primary burden of the debt is the annual interest charge. Ownership, about 80% of the total debt is held internally, and about 20% of the gross federal debt is public loans. So the debt as a percentage of GDP it's reduced during this period. And then, so like the Canadian government brought it down. Then it went up around 1980 to about 1995, and then it went up during that period, and then it went down again, 1995 to about 2010. So it went down due to surpluses from the federal. And then 1980 to 1995 went up due to deficits from the Canadian. So Canada has one of the lowest public debts as percentage of GDP. They're pretty low. However, countries like Japan, Greece, and Italy have some issue with that. They, yeah, but Canada is pretty healthy in terms of that area. Yeah. So Canada's debt is broken down in this case here. So, so the Bank of Canada lends about 40% of the money to the government. Then banks lend about 57%, and then foreign investors lend about 29% to the government. So the Bank of Canada debt works as so Bank of Canada, they print money and lend that to the government of Canada. So like so this happens with 14% of the government of Canada loans are from the Bank of Canada. Yeah. So that's how the money is provided. And then so Canada owes a substantial portion of the public debt to itself. Like that's shown as like when they say that, that means that the government, the Bank of Canada, prints money and loans it to the government of Canada, and also public lends. So like we could lend, like anyone, like I could, you could, we can lend Canada savings bonds, T-bills, and T-bills to the government of Canada. So if you buy a T-bill or Canada savings bond, you are lending to the government of Canada. Policy. So medium of exchange allows society to escape the complications of barter. So like medium of exchange is what currencies do to for transferring, like trading basically. So unit of account, it does that too. So we measure the value of goods and services in dollars, then store of value possible to acquire goods and services at a future date. And liquidity is the ease to which an asset can be converted to cash with little or no loss of purchasing power. So cash is fully liquid, so you can just trade it for any service or good. But something like stocks, you got to sell it first before you can, get money for it, basically. So M1 is coins plus paper money. So that's what M1 is. M2 is M1 plus like savings accounts, basically. Like you would count savings accounts for counting that, and also term deposits. Yeah. So M2 is bigger than M1 because it has this. So M2 would be, it's basically M1 plus savings accounts, basically. And then M1 plus is basically just cash. Yeah. Then M2 plus includes money from like credit unions and money market mutual funds. Then M2 plus plus is Canadian savings bonds and also non-money market mutual funds. So value of money, is due to scarcity and legal tender and acceptability. So bank assets, like ICBC in China has the highest amount of bank assets worldwide with over 3 trillion in US dollars. HSBC is second, JP Morgan Chase third, and then down the list. So what caused the 2008 mortgage crisis in the United States is that the housing market crashed, and this was caused by banks giving loans to people that can't pay it back for houses, and that was the crux of what happened in 2008. So in order to increase the money supply, banks buy bonds from the market. That increases the money supply. And then to decrease the money supply, the Bank of Canada sells bonds to the market, to the public. And in order for, so the banking system is, so how the banking system works is like you deposit money into your account. The bank lends that money to people, and then in order for you to withdraw money, the bank has to borrow from other banks for the cash because they lent out your cash basically, and they pay the overnight loans rate for the borrowing. But the other banks may not have any cash on hand because they may be lending out that money too. So the bank may borrow from the Bank of Canada if no other bank has any cash on hand, because the Bank of Canada can just print more. So that's basically how it works. Yeah. So that's basically the banking system in a nutshell. I'm just gonna, I have this video to show you about. So it's about Bitcoin. So with Bitcoin, it's so Bitcoin's going to transform the, so Bitcoin will transform the monetary system. So what's happening with the monetary system now is that, so right now, the Bank of Canada can print money to increase the money supply in order to grow the economy. Also, the government of Canada can borrow from the Bank of Canada, and they would borrow the printed money from the Bank of Canada to pay off the deficit. So they can do that right now, but with Bitcoin and cryptocurrency, the government has no control over it. So the government cannot print more to pay off the deficit or use to grow the economy. Bitcoin is fixed at 21 million units. Therefore, the government cannot increase it to pay off debts or grow the economy. So they cannot use monetary. So if Bitcoin was the only currency, the government cannot print more to fund their debt, to pay liabilities / debt, or grow the economy. So that's a big thing. So that'll change. It'll change monetary policy completely. Yeah, and then also Bitcoin has value because it's scarce. It only has 21 million units. Therefore, and will not increase or decrease. Therefore, the scarcity / limited supply / rareness is what gives it value. If it had, like, let's say it had, let's say Bitcoin had let's say that it had this much units in supply, Bitcoin would be worthless. Therefore, the value is in rareness / scarcity / limited supply. So it's similar to gold. Gold has value. Gold has value because it's rare. So like rocks are everywhere. So like general rocks are everywhere. So rocks are worthless. So like if you can get something, like if you can get something anywhere and it's not rare, it's worthless. So in this case, like the Canadian dollar is only valuable when they don't print a lot of it. If they print like this much Canadian dollars, it will be worthless. So like you need to keep the supply low. Give it value. So that's basically it. So this is going to change. The cryptocurrency is changing monetary policy completely.